current mentoring students have shorted, and we'll go through some structures. Just a little bit of advertising for the new POTM, the Professional Options Trading Masterclass 2.0. So as many of you probably know, the new version is going to be released in October, which will be a big upgrade on POTM 1, and it will include everything that we teach our students through the mentoring programs, plus lots of other option strategies as well. So it'll be a big upgrade on POTM 1.0. But if you apply to subscribe to the POTM 2 until October, you will get access to the POTM 1, so you can look at that before POTM 2 arrives, and then obviously when that arrives, you will get access to that. So, more details about that and potential discounts are on the website itpm.com. Just going to go through a few upcoming events before we get into the guts of the subject matter. So, mid-September, Anton's going to be doing a mentoring day in California at Newport Beach. I think he's going to have Ben and Raj there as well. As the description says, that'll be quite an intense day in the classroom, basically giving you a head start and giving you some understanding about how we look at the world, how we generate ideas, and how we put on trading strategies. So details for that again will be on the website itpm.com seminars. Some of you have probably seen the video that Anton made, I think in 2015, the 10 Secrets video. So he's celebrating 10 years of that with a party in New York a week after the mentoring day in California. So this will be in New York City on September the 21st. And as you can see there, he's going to put 10 grand behind the bar to celebrate 10 years of the 10 Secrets. And again, details on the website. So the examples that I'll be going through today are actually from a couple of trade ideas that some of my Thailand mentoring students have put on. So as you know, we do Thailand residential mentoring every year in April. So it's myself, Ed, and Anton this year. And as you can see there, we had quite a few students. And we'll be going through, actually, I'll be showing you their returns, what they've generated, and also going through a couple of their ideas. So if anyone's interested in the Thailand mentoring for next year, this is what you would be getting. So you get access for 12 months to all of the online video courses. You get access to our premium Discord service for people who are being mentored, which is called Society. You get 12 months access to the all the economic data that we produce, which is for the US, the EU, and China. You get 4 days in the classroom, which is pretty intense. You get separated up into groups and you do homework together. And then once you've finished all that, after the 10 days, which next year will be with Anton, Ed, and Ben, you then go back to your respective locations and start the mentoring for 12 weeks. Here's the full suite of all the senior trading mentors. So obviously everybody knows Anton. Anton doesn't actually do any mentoring programs now. He just teaches the classrooms. So the remote mentoring and the time mentoring will be done by the senior trading mentors. So that's me, Ben, Ed, Hisham, Anthony, and Raj. And we have 2 junior mentors who help people in terms of the remote programs get set up a couple of weeks before the student then starts to be mentored by their senior trading mentor. My background, left Oxford University in June 1992, went straight to the investment banking part of Barclays, which these days is called Barclays Capital. In those days was called BZW. Started off on the graduate trainee scheme and then went over to proprietary trading, where I started on the European equity proprietary trading desk as a prop trader. Then I went to the event-driven special situations desk, and latterly became part of what became known as Modal Capital, which was the internal hedge fund at Credit Suisse First Boston, because Credit Suisse First Boston ended up buying the equities businesses of Barclays. So that took me up to 2000. After 2000, I went off for 3.5 years and set up an event-driven volatility long-short hedge fund for these guys called Mako. Did that for 3 years, 3.5 years. Then I went back to the investment banks, initially to Commerzbank, where we had a $2 billion multi-asset class, mainly equities and equity derivatives portfolio. Lehman Brothers with $500 million, and then last place before I left the city was a Canadian bank called Toronto Dominion, where I ran a $500 million long-short equity and equity derivatives proprietary trading portfolio. So remote mentoring, if you ended up mentoring with myself, what you would do is you'd have 12 calls over 3 months. You'd be set homework between each call each week. That's probably about 10 to 15 hours a week of work that you need to do researching. You get access to all of our online video programs, including the new POTM. And most importantly, the one-to-one mentoring, what it teaches you how to do is basically, most importantly, how to generate professional level trade ideas. Then once you've got a good idea, because the quality of the ideas is really the foundation of a good portfolio, we'll then teach you how to optimally structure the options trade around that idea to try to maximize your return on investment. We'll show you how to manage the business on a monthly basis, going through at least 3 expiries. And obviously we'll move on to how to construct a diversified long-short portfolio and how to run your portfolio from a purely professional perspective as a business and as an ongoing sustainable business going forward. These are the results for my students from Thailand this year. This was as of week 11, so with 1 week to go. I'll go through it very briefly. So I've got 9 students. As you can see, there are various levels of capital, ranging from $50,000 up to $300,000. The returns are ranging from Victor at the top there with just over 43% positive return, down to the bottom where we've got people essentially flat. But the average return across all of my students from Thailand was 25%. That's over those dates between May the 5th and yesterday. That's an outperformance on average over the S&P of 14%, the NASDAQ 11%, NASDAQ Composite 9%, and the Russell 2000 16.5%. Now don't forget, that's 3 months of performance. And also our portfolios are long short as opposed to the market, which is clearly long only. So we've got some pretty good results there, and the averages are looking quite good. This is the overall picture for Ed and Anton and myself. This was a snapshot taken at about halfway through, so these numbers are slightly different because this was as I say, as of week 11, so there's only 1 week left after that. This is about halfway through, but you can see there on average about halfway through we were outperforming the market to the tune of, depending which index you look at, of between 6 and 10%. And obviously, as I say, long short portfolios here. Right, on to the first example. So this is a short that actually more than one of my students has got on. These guys are going to be reporting DBX Dropbox next week. So we'll see what they come out with. You can see the forecast figures here. So just briefly going through this, you had pretty strong growth for 23 and 24 in terms of EPS. That EPS growth has basically fallen off a cliff for this year and looks fairly average for next year. If we look at the revenue level as well, as you can see, revenue growth is actually going negative. So it's actually falling this year with a small drop in terms of consensus numbers predicted for next year. So, these numbers are going from, in the last couple of years, fairly decent EPS growth to basically pretty meager EPS growth, and actually now falling revenues. And what we think is that this is a pretty competitively challenged company that's overpriced in a market where it doesn't have a great deal of a moat around its business. And belatedly, they've kind of cottoned on to AI, but we're not particularly convinced by their AI strategy. To go into this, a little bit more depth, as you saw from the numbers, the stock is basically X growth, and it's operating in a very competitive space. We've seen weakness across things like Teams, and also the document workflow businesses like DocSend and Sign. They decided to get rid of their as much space as you need policy in the advanced Teams plan and transition to a metered model, which is expected to increase the churn rate, which is going to affect the average revenue retention, at least in the short term, to the negative. They're also, as in the company themselves, are expecting slowing billings in the legacy business. And their new ideas like Dash and bundles and video products, not really expected to make much of a positive contribution in the next 3 months, which is kind of our time horizon. As previously stated, significant competition in the sector in both terms of the platform and cloud storage market. Pretty well-known household names there. Microsoft, Atlassian, and Google are some of the major competitors. And then in terms of the cloud storage market, you've also got Amazon, Apple, Slack, and Adobe, just for good measure. In the cloud storage market, with respect to large enterprise deployment, they're obviously competing with Box, and of course with Adobe and DocuSign in the electronic signature market. So basically, these guys are facing a lot of competition, and they don't really have much pricing power, which is why profitability is under pressure, and we can see that in their numbers. Here is a chart of the stock going back to the beginning of August 2015. So it's actually the reason it starts in 2018 is because that's when the stock went public. And as you can see, over the entirety of the history of the company since it's been listed, it's basically gone nowhere. Yes, we've had sort of full round trips, but since the IPO, the stock price has essentially done nothing. This is just a 1 year chart. Actually, no, it's a 1.5 year chart going back to the beginning of 2024. So you can see that big kind of drop back in February, which was on the back of a bad earnings report and bad guidance. So we have been here before. Obviously, the stock price has recovered a little bit, which is good as an opportunity for shorting. Here's the options chain. For those of you who are not familiar with options chains, on the left-hand side, you've got calls, and then you've got different months with different strikes. So at the top there, you've got the 15th of August, which is the standard expiry for August, with various different strikes. Then you've got the September standard expiry, October, etc. And then there's a gap until January because the options for November and December are not listed yet. On the right-hand side of the screen, you've got the put side. So same expiries, same strikes, but they're puts. And this is the structure that a couple of my students have put on. So it looks like it could be quite complicated, but it's actually very easy to understand. So this is what is known as a calendar spread. So your long September puts in this case and short August puts in this case. So the calendar aspect refers to the fact that the long side of the trade expires later than the short side of the trade. So your long September 27 puts in this case, your short August 26 puts in this case. So you've actually got different expiry dates, long September, short August, and you've actually got different strikes as well. So long the 27 strike, short the 26 strike. Now I did the prices here were done, a couple of days ago, and obviously we had a bit of a sell-off at the end of last week. So the underlying price is now actually almost exactly between the two strikes. It's about $26.50. So the trade's already working. Now, what we do here, the reason you're seeing three different scenarios is we model what the P&L will look like, or is likely to look like, if we have different scenarios. So in each case here, we're spending 7,600 by buying 80 contracts of the September 27s. And we're receiving $1,600 for shorting 40 of the August 26 strike contracts. So in each example, it's the same structure that we've put on. We're long 80 September 27s, short 40 August 26s for a net spend of $6,000. Now that we're using $6,000 because if you remember going back to my students, they've got different levels of capital. So we basically assume a kind of standard $100,000 in the trading account. And if you've got $100,000 account, then you might put a net spend in here of about $6,000-7,000. Obviously, you adjust that net spend depending on how much capital is in the account. So assuming we've got a $100,000 account, we buy the 27s for September, sell the 26s. Now, what happens if the price immediately of Dropbox goes straight to our target level? So in this case, let's say our target level is $24, which is about 15% below where the stock price was when we put the trade on. So the stock price for Dropbox when we put the trade on was around $28. Let's assume that it immediately shoots down to 24. Then, of course, what we'll find is that the August contracts that we're short of are in the money. Ideally, we don't want that to happen, because what we want to do is take a credit for August and then be able to put on another structure on the short side, and then the stock price falls, and then we really maximize our profits, which I'll show you. But let's just assume, because we don't know, we can't predict exactly what's going to happen to stock prices and when, that the stock price immediately drops to 24. So it means that we're in the money with our 27 strikes for September, but the 26 ones that we're short of are now also in the money. And let's assume that that's the price at the expiry in August. So the intrinsic value, which you can see in column here with IV above it, the intrinsic value of those options, clearly, if the share price is 24, would be $3 for the 27 strikes and $2 for the 26 strikes. However, the August ones, because it's now expiry day, will have no time value, whereas the September ones will have time value. In this case, we've assumed 20 cents of time value, which would mean that you've got $3 of intrinsic plus 20 cents of time value, equating to a total value per contract of $3.20 for the 27 strikes for September. And of course, only $2 for the 26 ones for August, because it's on expiry day, so they have no time value. So if that were the case, obviously you make money on your long of the 27s, but you'd lose money on the short August contracts. However, overall, you would still make money. So your payoff there would be just under 2 times. So you've spent 6,000, but you still would make 11,600, which is almost 2 times what you've put in. So that's with the trade not going exactly how you want it to go, but you're still making a reasonable return. So it kind of makes you agnostic, is what we say, in terms of where the share price is going to go. But let's say we have the kind of best case scenario where the share price doesn't go below $26 before the August expiry, and then it goes down afterwards. So what would happen? So if the share price goes to 24, but it doesn't go to 24 until after the August expiry, and it actually stays above 26, then we would obviously receive the credit here. Now, we've modeled here that we're going to pay 5 cents to buy those back if they start trading down towards being worthless. So if we pay 5 cents to buy those back, we'd be locking in a $1,400 profit. And then subsequently, if the share price went down to 24 by the September expiry, you'd be making 19,400 on your $6,000 outlay, which of course is over a 3-to-1 reward to risk, which is a great return. And that's what we're basically always trying to get, is that 3-to-1. So this is how the numbers would work if we took the August credit and then the stock price subsequently fell to 24. Now, really blue sky scenario in the third example, or the third scenario here, is we've taken the credit and then in this case we haven't taken the credit. The stock price has just dropped by 30% to $20 before the August expiry. So we're still losing money on the August expiry, but because we've done this, it's important to notice that we do this on a ratio. So it's a 2-for-1 ratio where we're long 2 contracts for every 1 contract that we're short. Because of that structure, and because of the fact that the share price has dropped so much, your P&L would look like this. So it would be an almost 5-to-1. And that's where you haven't taken the August credit. It's actually gone against you. You've lost $5.60 per contract, but you've made $6.35 per contract on the 27s that you're long of, but you're long 2 for every 1 that you're short, hence why the P&L looks like this. And that's where the stock price drops precipitously by 30%. And we've seen stocks actually doing that this week. There's a stock called Confluent CFLT, which disappointed on, I think it was Thursday, and it gapped down 30% on the open. So not necessarily saying this is what's going to happen with Dropbox, but modeling what that would look like if that were to happen. Let's move on to the second example, Best Buy, ticker BBY. Again, just starting off with the EPS and the revenue numbers here. So as you can see, they've been struggling for quite a long time, at least going back for the last 3 years. So this is the EPS growth rate, which is actually negative, obviously. So the EPS has been falling for the last 3 years and looks like it's going to fall again this year. The analysts at the moment are currently modeling a rebound, a kind of modest rebound next year, but who knows? This is a business that we think is severely challenged and possibly in structural decline, which I'll talk about. So the EPS picture looks pretty horrendous. Revenue has been also under pressure for the last 3 years. I mean, if you want to be positive about it, I suppose what you could say here is that these revenue kind of shrinkage levels are getting smaller and smaller. So the revenue growth is decreasing by smaller amounts each year, but still, you're basically losing revenues here and earnings are going down. So as I say, it's been structurally challenged for at least the last 3 years, and we still think that that is the situation. As you saw, declining revenues for quite some time. It's an ongoing pattern. We think that there are structural issues with respect to the consumer electronics retail sector. As you saw in those numbers, continued weakness in the top line revenue and comparable sales. So Q1 of 2026 fiscal year. So they have a weird fiscal year which ends in January. So we're currently in the fiscal year which ends January 2026. So for their Q1 2026, revenues basically fell by just about 1% year on year. Enterprise comparable sales fell by 0.7% year on year. So it's demonstrating sustained weakness in consumer spending on discretionary electronics. They had to lower their guidance, which doesn't look like much, but it's all going in the wrong direction. They had to revise the comparable sales forecast down as well, to a range of -1% to up 1%, compared to previously flat to +2%. And they've warned about their operating margins as well. So we've got pressure on the top line, pressure on the bottom line. Bottom line profitability is showing weakness on a year-on-year basis. Last set of results, adjusted EPS fell 4% from the previous year. We know who the competitors are. It's obviously people like Amazon, Walmart, GameStop, and that's a pretty formidable challenge for them. We've obviously got the relentless expansion of e-commerce, particularly with Amazon, but also Walmart is a big competitor, GameStop, and they've changed the competitive landscape over the last few years. Of course, there's been a massive increase in online shopping, but also the competition aggressively prices as well. So that's part of the problem here, is that BBY doesn't have any real pricing power, slightly similar to Dropbox. Here's the chart going back 10 years. So you can see it's had a proper round trip as well. Getting up to the highs there of 140 towards the end of 2021, and here we sit with the price having halved over the last 4 years, and basically looking fairly unhealthy. This is a 12-month chart going back to the end of July last year. So we have seen, we've seen a decent bounce since the April tariff tantrum lows, which is good, because again, that's an opportunity potentially to get short into. Once more, here's the options chain. This is actually from the 28th of July, so it's a couple of days out of date. And here's the structure that a couple of my students have put on. Again, it's another September, August structure, so calendar structure again, obviously a put structure. And I think you've probably got the gist of how these work, so I won't spend so much time going through this one. But it's your long September 65 strike puts. When these trades were put on, the price was around 65.79, so just below $66. So the trade was long the September 65 strike puts, short the August 64 strike puts. And as you can see over here, these are the scenarios. So the numbers aren't quite as juicy as they are with Dropbox, but they're still pretty respectable. So what if we get an immediate drop in the price to $55, which is 16% below where the share price was when we put these trades on? So we get the immediate price drop in the share price. September and August contracts are both in the money. So if we get it down to 55, and this is the 15th of August, so August expiry day, then clearly the long contracts for September are going to have $10 of intrinsic value, which is that column there, IV. We calculate they should have around about 60 cents of time value, because obviously there's still more than a month to go for those to run. The August 64s, so it's a lower strike, would clearly have $9 of intrinsic value, nothing in terms of time value because it's expiry day. So again, on a 2-for-1 basis, if you're long 20 contracts, short 10, your P&L is going to look like this, where you make just under 7 grand for a net spend of just over 5 grand. So that's a 1.3 reward to risk, which isn't amazing, but don't forget, this is where you've seen the share price immediately drop. So therefore you're not taking in your August credit for being short the 64s. So if that's our worst case scenario, then, you know, we can probably accept that. What about if we get, if we actually take in the August credit, so the 64 strikes that we're short expire worthless on August 15th. What do we take that credit in? And then subsequently between the August expiry and the September expiry, the share price drops to 55, then the P&L is going to look something like this. So, you know, almost 16 grand return on just over 5 grand outlay. Now, don't forget as well, if you do that, you're going to get the opportunity to put on a vertical as well, because if you've taken the credit for August and now you're just left with naked long the Septembers and the share price has dropped, you've then got the opportunity to bring in a nice juicy credit by setting up a September vertical, which is where you might short, let's say if the share price goes to 55, you might short the September 55s at this stage, having taken the credit for the August 64s that you were short of, and get a nice credit for the 55s and basically, you know, lock yourself into a trade either extremely cheaply or potentially for free. And then down here, you know, we've got this kind of blue sky scenario. What if the share price drops by 25% down to $50? Then you would potentially make a 5-to-1. That's here. What we've modeled is that the share price has stayed at 64 or above until the August expiry, and then it drops down to 50 by the September expiry. In that case, you know, you'd make a 5-to-1. But even if you didn't take in the August credit, you would still, because the share price has dropped so much and you're long 2 contracts versus short 1 contract, you would still make over here probably 3 times your money, and then you'd be able to set up, you would potentially set up a vertical as well, depending on obviously what the share price does. So these are, you know, these are not complicated structures, but they do, you know, you do need to be careful in terms of how you set them up and the strikes that you choose, how much credit you're looking to take in, the structure in terms of the ratio that you do. So there's a little bit of expertise here that we need to teach people. But, you know, these are kind of typical structures that the students are putting on by the end of their mentoring. So yeah, just another quick word. Obviously, you guys know that we got POTM 2.0 coming out in October. And until that time, if you sign up for it, you'll get access to POTM 1. As I said before, Anton's going to be doing a mentoring day in the classroom on September the 13th at Newport Beach. Details on the website, itpm.com. 10 years anniversary celebration of the 10 Secrets video. That'll be in New York a week later. He's putting 10 grand behind the bar. That'll be a very fun evening. Yeah, we're now taking applications for the Thailand program, the Thailand mentoring program for next April in 2026. So please, if you're interested in that, then, you know, have a look at the website. And what you'll discover is that you get access to all of our online video courses for 12 months. You get access to the premium Discord, which is called Society, all the data, 4 days of classrooms, and then when you get back, you then start your remote mentoring with either Ed or Ben. You've seen us before. You can have a look at us on the website and read about all of our backgrounds. So we are currently accepting bookings for the Q3 and Q4 remote mentoring, which, as previously described, is basically 12 calls of at least an hour over Zoom, one-to-one with your mentor. 2 weeks before you start, you get access to either Phil Klein or Dieter, who are down the bottom there, and they will basically prep you to start your mentoring in a couple of weeks. And as previously said, included in that is access to all of the online programs, all of the economic data, of course, 12 weeks of mentoring one-to-one, and of course the POTM too. So yeah, probably don't want to repeat this. So I'll just zoom through this. It's one-to-one mentoring, and basically this is what we're trying to achieve, to get you to be able to generate professional standard trade ideas, how to structure your options positions optimally to maximize your rate and your return on investment, how to run this as a business to make sure that you're making money and compounding it on a monthly and annual basis, how to put together a proper long-short portfolio expressed through options, and of course managing both preemptively and reactively your portfolio. Lastly, just a quick mention of our Discord servers. Society you've heard about, that's for people who are either being currently mentored or who have been mentored. All the mentors are on there as well, including Anton. Study Hall is our Discord thread for any alumni of ITPM that have done any of our online courses. Right, so that's me. Let's get on to some questions. Okay, Colin, do you unwind the trades if the short leg gets deep in the money before expiry to prevent getting exercised? Yes, but you would do something on both sides, Colin. So as we showed through the scenario analysis there, you wouldn't just buy back the short that's in the money. You do something with the long that's also in the money, and you'd be locking profits in. How will the media narrative have a role in idea generation? Absolutely. Well, I wouldn't say absolutely irrelevant, Harish, but pretty much irrelevant. What do journalists know? They generally fit stories to price moves, not the other way around. How often do companies manipulate their own stock, for example, earnings results? Do you think that man landed on the moon or not? These are conspiracy theories. Companies and their executives, if they try to manipulate things or lie, they're basically running the risk that they end up being sanctioned by the SEC and potentially put in jail. So no, they don't manipulate their stock prices before earnings results. Right, okay, so somebody here, Marco, wants to know about the Greeks. Marco, we're not going to sit here and give you a theoretical lesson about all of the Greeks. And by the way, that's not how you make money. You need to come up with good trade ideas. You can be the best mathematician on the planet. You could be awesome with all your Greeks. But if you've got shit trade ideas, you're going to have a shit portfolio, and it doesn't matter how much you know about options. Okay, so a couple of questions here regarding the video series. Is it okay for me to buy the IPLT video series, then upgrade later to the PTM and the POTM? Yes, of course it is. Absolutely. That's quite an interesting question. How are your students leveraging AI? What is the most compelling use of AI you've seen in trading? I mean, it's a bit, I suppose it reminds me of garbage in, garbage out, Tom. So, they leverage AI to help them with parts of their research process, but they need to go and sanity check it. So you can't just, stick a bunch of search terms in and then just take it as given that AI has given you the correct answer. You've then got to go and actually sort of do due diligence on it. So it does help save time on the research side, but it's not infallible. So you do need to to kind of verify, which only really you can do by sort of going to company websites and going and looking at investor presentations and things like that. Macarius, I'm not telling you how we calculated the time value. That's not the purpose here. We're not going to go into the technicals. If you want to know how to do it, then subscribe to POTM2 and you'll have all of your answers. Both expires after the earnings call where volatility is to be expected. Is it really reasonable to put just $1? Well, that's why you do it on a ratio, Florian. And that's why you do the scenario testing. Okay, yes, I suppose quite a few questions here on how we would manage the trade. When the price reaches the short leg strike, should we close the short leg? Because if we only close the short leg and the price moves back, we might lose the profit we had. Correct. You need to do something on both sides of the trade. Okay, so I think that's a good question, Marcel. What's the amount of trades one should have on, depending on the amount of capital? So on the amount of capital, obviously we are using leverage because we're using options, but we think there's like a critical kind of mass that you need a minimum level of capital. So on the minimum level of capital, you need at least $25,000. So you don't need 100, but you do need at least $25,000. In terms of the number of trades, I think the sweet spot is 10 to 12 strategies. So when I say a strategy, if we have a calendar on with Dropbox puts, that's one strategy. So I think that you should have between 10 to 12 strategies. Much beyond 12, you've got too many things to look at, too many moving parts, and you might miss something, drop the ball, and then end up with something that costs you that you just weren't on top of. And I think 10 gives you enough kind of diversification to to ensure that you're not too heavily concentrated in either any one theme, any one sub-industry sector, etc. And also you want to think about what is my expiry exposure as well. So on the particularly on the long side where you've spent premium, you don't want to sort of come to the beginning of September and maybe have 5 out of 10 of your long expiries are all in September, where you've obviously got heavy concentration expiry risk. So that's the kind of thing that we would address and teach people about in the mentoring as well. Francisco, how much emphasis do you put on top-down analysis versus bottom-up analysis? Good question. There's no set kind of ratio. I mean, what I start with the top-down because I think it makes more sense to start with your top-down, with your kind of big picture, what we call your worldview in the PTM. I think it's a good place to start with that. And then once you've got your worldview in terms of what you think the economy is doing, where you think interest rates are going, where you think fiscal policy is going, looking at the leading indicators and spotting where you think are going to be the outperforming sectors versus the underperforming sectors, then you go and build it up from the bottom up. Because your worldview, don't forget, economies kind of move a bit like super tankers, especially when it's a big economy like the US. It's not like every single data point, you get some new kind of that you're going to suddenly change your viewpoint on where the economy is going. It's more of a slowly, gradually evolving thing, and of course one individual data point might be volatile, so we're not going to base our entire top-down view on just one data point. What we're looking at is where are the trends heading, and so that is something that develops over time. It's not something that changes from kind of month to month. So can you talk a little bit about how you identify the spreads between strikes and your trades on the long and short side? It's dictated by the market, Nicholas. So, we're looking at the risk reward and we're trying to maximize the risk reward. So, we'll look at in the money, out of the money, as well as at the money. And depending on what the relationship is in terms of what the options market is offering us, that will dictate what we do. So there's no kind of like cast iron. We will always go at the money, and this will be the difference between the strikes. Because sometimes we might do the same strikes. It just depends on the modeling of where the prices are that you can currently pay and receive in the options market, and what your position would look like given a particular price move. So we got a few people asking, what would I make of yesterday's jobs data, the tariff news? I'm not here to tell you what to do with the market. What we are about here is educating people so they can come to their own conclusions. So we equip you with the information and the knowledge, and you are then able to do this independently. So, we're not kind of like a copy trading service, basically. Yeah, Scott, I can't really give you a general rule, because so Scott's question is, if a stock has been hammered and is down to like $7, but you think after your research you could get hammered again, would this be a viable option, or would you swerve it as it's down too much already? It's very much case dependent. So you might remember Credit Suisse a couple of years ago, and a lot of institute traders, a lot of ITPM traders had the short on in Credit Suisse, but when they put it on, a lot of them were basically the strikes were way out of the money, and we called it it's a kind of trade we call a tail risk trade. So the position was way out of the money, and it was quite long dated because we didn't also know when Credit Suisse might go. But if it did, then clearly, it was going to go virtually to zero. It didn't quite go to zero, but it basically went to zero. So, in that case, then the stock had already been hammered for quite a long time, but there was still, we thought, a good risk reward in putting that trade on. But it's not always the case. So, again, Scott, I can't really generalize for you. You've got to look at each situation on its own merits. Daniel, that's a nonsensical question because it depends how much capital I was running at the time. The bigger the book, the bigger the P&L swings. Daniel wants to know, what's the maximum you've made in one day trading? What's the maximum you've lost? Well, I'll tell you what, when I had a €2 billion portfolio, I had much bigger P&L swings than when I had a $500 million portfolio. Other than that, nonsensical question. Right, not going to answer questions about where I think the market's going. That's why we have long short positions. And that's what you could see from the results of my Thailand students, and also from from Ed and Anton's students. We're making money where the market has basically gone up in a straight line from April, but we've got longs and shorts on. And there are short trades that, for example, like Lululemon, where students have actually made fantastic returns from short ideas. So I'm not going to tell you where I think the market's going, because again, it's not the point. How do you decide whether to set up a calendar trade or a vertical? Risk reward sailing, simple as that. At any given time, do you hold any cash, or are you fully invested? Good question. Yeah, we always hold some cash back in case something juicy kind of arrives just before expiry, in case we need to do a repair or something. So it's always good to have a little bit of spare capital. Yes. Yes, Matt. To mitigate expiry risk, is it prudent to stagger expiries? Yes, but you can have more than one. You can have exposure to more than one in the same expiry, if you see what I mean. So, you know, if you've got a portfolio with 10 positions in or 10 strategies, there's no harm in necessarily having 2 or 3 for 1 month. And also don't forget, as we sit here on August the 2nd, we might have more, we might have 4 or 5, but we won't have those by the time September expiry comes around because we're trading. Okay, so yeah, good question, Saline. What kind of data do we receive from the 12-month Discord Society subscription? So it's all of the US data, both leading economic indicators and the coincident. So as in now, so all of the US data, all of the EU data. And the Chinese data as well. And the big thing about the Society Discord is that you're in there with other people, all of whom have been either mentored or are currently being mentored, plus all of the senior trading mentors are in there, including Anton. I'm trying to get through a lot of questions here. They're kind of queuing up, so give me a chance. Yeah, Angus is asking, how can you touch on how to repair trades if they're not going well? It's kind of beyond the scope of this webinar, Angus. We'd need to talk through some specific examples. I can't really talk generically about that. If a company is failing to meet its KPIs, is this considered a good indicator to short the stock? It's certainly not the best, is it? So whilst I'm not going to generalize, in and of itself, a company failing to meet their KPIs and doing so on a kind of repetitive basis is certainly not a good indicator. Yeah, I'd agree with you, Yaskaran. Sam, do you ever trade intraday, or do you prefer trading over a longer time frame? So we tend to trade over 2 to 3 month time horizons, but sometimes we'll have the odd situation that goes longer, like the Credit Suisse situation that was quite long dated. We don't try to trade intraday, but if something happens intraday that either you need to trade or you can trade advantageously, then of course you're not going to turn down the opportunity. But it's not the core of what we do. It's not what we're looking to do. That would be much more opportunistic, because if you look at how markets move generally since QE, quantitative easing, volatility has really died down. Yes, obviously sometimes we get extreme volatility, like during the COVID sell-off or the the tariff tantrum earlier this year. But generally speaking, the level of overall volatility has come down, which has decreased the opportunity to make good money out of day trading. Matthew, what are the key components of a management operating plan? Buy the PTM, my friend. Okay, right. So another question here from Pedro. So I want to do a 12-week program with you in about 6 months' time. How do I go onto the website to apply for a mentoring program with you? Yeah, it's pretty simple, Pedro. Just go to the mentoring section, and there's a button there that you can use to contact us, and you fill in a form. Obviously, with things like who your preferred mentor is, your trading experience, and there's a few other questions on there. And it's as simple as that, really. This is connected as well. Our absolute beginners, welcome to ITPM. Where's the best place to start? Best place to start is the video courses, and you start with the PTM 2.0, because there's no point as I said earlier on, in thinking that you understand all the Greeks and you're going to be a great options trader if you don't have any good ideas, because it's all about fundamentally based good trade ideas. So on the table there with the returns from my students, what you didn't see was the average win-loss ratio. And so the average win-loss ratio for my students at the moment with their trade ideas is 60-40, which doesn't sound amazing, right? But if you know how to trade the winners and you know how to control the losers and you compound that, you're going to get great returns. And in fact, a very famous hedge fund manager called Steve Cohen set up SAC. He's on record having said that his best traders, their win-loss ratio is 60-40. So that's where we're getting our students to. But you need good ideas. And so where do you start with that? Is the PTM. Yeah, so Vic, is it necessary to get PTM and POTM before the mentorship? Yeah, you need to have done, you definitely need to have gone through and done the whole PTM. Ideally, have gone through the POTM as well. But as long as you've started that, then you'll probably be okay, because we will go through structuring together and I'm going to help you, a lot at the beginning and steer that process. And the ideas will get you to becoming independent with that process by the end of it. But you definitely need to have done the PTM and ideally the POTM. So that answers your question, Dave, as well. Yaskaran, is credit harvesting possible with a 25 grand account, or would you require a larger account? Of course it's possible. You just won't harvest as much credit from an absolute level, but of course it's possible. You might be dealing with lower priced stocks because, of course, the higher the stock price, the higher the options price is going to be. So that wouldn't be, if you've got a smaller amount of capital and you've got highly priced stocks, it restricts the number of contracts that you can go long of, right? Because obviously it's all related to, there's a relationship between the options price and the underlying price. So the higher the underlying price, the higher the options price is going to be, which can restrict you. If you're down at 25 grand, you might, in some highly priced stocks, only be able to buy 1 or 2 contracts. So that would be a bit restrictive. But if you're trading lower priced stocks, then of course you can trade more contracts. Ashcat, nice try. Not going to tell you. Yeah, Sailing, do people ever do remote mentoring first, then Thailand program? Absolutely. Yeah. In fact, I had one of my 9 students this year. They did remote mentoring with me in Q1, and then they came to Thailand in April. So yes, we some people do that. Cosmin, hi. I keep hearing in trading you need to do you. There's no recipe. I understand there's no rule book, but would you say is nonsense and the framework that ITPM is offering is the actual framework that pros are using too? Okay, so Cosmin, if you look at, if you go onto the website and you can see the background of all of the senior trading mentors and Anton, you can see we all come from the industry and we all ran money. We weren't brokers, we weren't stockbrokers. We ran money on Wall Street in the financial district of London, the city, for banks and hedge funds. So we did this as professionals, and the PTM, it's not the only way to do things, because you have different styles of trading and idea generation, but the PTM is one of the, we find, the easiest and the best frameworks that A, people can understand, and B, if people follow it and repeat it, that they will get good results out of it. So it's not the only way, but it's one that we find works and is easily comprehensible to people who are even, complete beginners. So the idea is that we can take you from zero knowledge of trading of stock markets up to a situation where you can do this independently and run your own trading business. Now, some people will need will need to be mentored. Definitely not everybody, definitely not everyone, but some people will feel that they need to be mentored to kind of take it to that professional level and to give them the confidence. And of course, that's right for them. But certainly with the online video courses, you know, you can go from 0 to being able to do this independently, which is the whole idea, as opposed to copy trading. Yeah, Vic, I've answered that question. Sailing, that's quite a specific question about during the mentoring. If I mentor you, I'll answer your question. Okay, Wei, is it advisable to start trading on my own after attend ITPM online courses first before going for mentoring? I would say that you should give it a shot. Yeah. So, you know, some people decide that basically they're going to go for the whole thing. They're going to do the courses and they're going to go for the mentoring, and that's what they decide at the beginning. But there's nothing wrong with doing the online video courses and then implementing or trying to implement, and then you can see, you know, and give it a few months. You can then see, well, do I feel the need to be mentored? And then if so, obviously you can then go for mentoring. But there's definitely nothing wrong with doing the online video courses and then implementing independently yourself, and then you can make your own conclusion, right? Okay, yeah, Neil. So just to be clear, so basically, if you sign up for the POTM2, which is released in October, in the interim, so if you sign up now, in the interim until October, and the new POTM comes out, you'll have access to POTM1, which you can then start going through, and then obviously once POTM2 is out, you'll then receive that, and you can go through that. Ashcat asking, is the cost of remote mentoring a significant portion of an account size of $50,000? No, I mean, it's not, you know, so we don't release the price publicly. You've got to go through the website and then fill in the form, and you know, then we'll get back to you with the cost. But it's the cost. It's the same cost for everybody, by the way. But is it a significant portion of 50,000? No, but it's not cheap either. Yeah, I mean, it's kind of like a bit of a how long is a piece of string question. But no, it's not a significant part of 50,000, but it's still, you know, a reasonable amount of money. Is the Dudakin still on the Thailand itinerary? Of course it is, Matt. Okay, Marcel, why does the broker not let me sell options at all? Well, they probably don't want you to sell naked options, Marcel, so you don't blow yourself up. Yaskaran, have you seen a big difference in performance between your mentees from Thailand and remote mentoring? Good question. Over time, I'd say no, because everybody gets there. But what I would say is that the people who go to Thailand, they get a head start, because of course they're there doing the mentoring classrooms for 10 days, and you're also part of a big group and you network and you're into groups doing homework together and stuff. So what I'd say is that as long as you put in the work, you know, you'll all get there. But if you've done the Thailand program, you're probably going to get there a bit quicker. But, you know, I mean, we're talking about 3 months, right? So I've just been finishing this week with most of my people. And what I've said to all of them is that, you know, whilst the 3 months looks great, you know, you've got to give this at least 12 months to actually make the numbers statistically significant, right? And that gives you enough time, whether you've done Thailand mentoring or remote mentoring. Jonas, I don't know the answer to that question. I think that's probably one that you need to ask through the website. Richie, the answer to your question is $25,000. Marcel, I don't know. I'm not in charge of your trading platform. Don't be ridiculous. Get in touch with your trading platform. No worries, Ashcat. So Nicholas, how much harder has it been for you to be at home trading on your own, not on a trading desk surrounded by others in the office? Yeah, it took a bit of getting used to actually, because of course, you go from it being a full-time job to, I do not sit sort of glued to my screens all day long, which is what you used to do, when you're doing it professionally. So it's a different sort of discipline. And yeah, it took me quite a lot of time to. It's more about not having that kind of camaraderie that you get on a desk. And there is an element of like bouncing ideas off each other. But even though I'm trading at home, obviously I speak to the other mentors. Still got mates that work in funds and banks and stuff. So and I'm still in like chats talking to my old bosses and things like that. So it's not like you're completely isolated, but it is different. I'd agree. Right, Eli, I have got no idea about gas storage. So, and even if I did, I would not be giving you the answer because you need to get your own view. Way, is there a fixed curriculum that all mentees will go through during remote mentoring, regardless who is mentoring? Yeah, we do. We do have a curriculum which Anton designed. But of course, we all have our own different strengths as well and experience. So the mentoring won't be exactly the same between every single mentor, but there is definitely a core curriculum that we're all adhering to, which has been designed by Anton. So there is some standardization, but you're going to get different nuances and different expertises depending on who you go with. And if you're interested in mentoring, I suggest you look at all of our backgrounds and you can decide which mentor is probably the most appropriate for you. Paul, I use ITPM data, LSEG, and Zax, if you're interested. Right, we seem to be running out of questions here now. It's more questions about trading platforms and data services and things like that. So thank you very much for coming along on a Saturday morning, afternoon, evening, wherever you are. Yeah, hopefully this has been useful to you, and hopefully it's given you a bit of insight into what our